Hey everyone, my name is Charlie and I'm a partner at Brooklyn Bridge Ventures. I'm so glad everybody could be here. I just wanted to give a few words before I call up our panel participants today to talk about rolling funds and syndicates and SPVs and sort of all the myriad of different options for capital formation. So this group that we have put together in this series is called New to VC. And the purpose behind New to VC is to give people who are relatively new to the venture ecosystem, particularly from underrepresented communities, an opportunity to sort of learn from experienced professionals, best practices, and all of that sort of stuff, as well as people who are hoping to break into these types of communities, which I think, the topics that we'll talk about today is sort of a stepping stone to being able to do that. So, today we'll make sure you're on the list for all of our future New to VC events. If you know anyone who is interested in that, again, particularly we're intentionally trying to diversify the group so that the next startup who goes and pitches a VC fund isn't pitching a bunch of guys that look like me. Feel free to introduce us to folks that we should be adding onto the list. My email is charlie@brooklynbridge.vc. And without further ado, I'm going to pull up our speakers, Alexander and Sunil. And where's the button to do that? Participants. My bad. Let's see. Oh,
I think we got it.
Okay, it's just on your side.
Yeah, there we go.
Okay. There was no button to click to call you up, and so I was a little
like, we're as speakers, so we just needed to turn our mics off and show our faces to be human here.
Fantastic.
You're doing everything right.
Yeah. Although, it's interesting. It's one of those user experience things that sometimes you have to assume that someone is going to make a mistake. Mm-hmm. And, while that wasn't necessary, maybe there should just be a dumb moderator button where it's just like, click this, and, imagine it will work out. Cool. So before we kick it off, I'll let you guys, starting with Sunil, just give a little bit of an intro and overview of who you are and what you're working on.
Sure. Real quick background. Grew up in Oklahoma, moved out to the Bay Area for school, did a few years of management consulting, got roped into the world of startups just on nights and weekends, started helping out companies, then ended up going to work at a venture capital firm. So I was at DFJ, Draper Fisher Jurvetson, which is $350 million fund out in the Bay Area, was on the early stage investment team. So, they were great investors early in SpaceX, Tesla, Box, Twilio, a bunch of great companies. So I was working there for about 4 years, got to do some interesting deals, got to meet with a ton of founders. And then after about 4 years, I wanted to leave and start my own fund. That's how I met Naval and the team at AngelList, learned about what they were doing a little bit more closely, and got recruited to work there. So I've been at AngelList for the past 4 years. I'm a partner on the venture team. My role specifically, I work with all of our GPs. So my role is to grow the GP side of the marketplace. If people are interested in SPVs, if they're interested in setting up a traditional fund or now a rolling fund, we can help to make it happen. And so excited to be here. Thanks, Charlie, for having me, and excited to jump into this and answer any questions people might have.
Cool. Alexander?
So I'm Alex Davey. I'm an attorney in Nashville, Tennessee, and I grew up actually in New York and spent some years in Philadelphia and then North Carolina, finally Tennessee, and a few months in DC as well. So I've lived around. I've been an attorney since 2003, and right now I really split my practice between helping people form investment funds, whether they be SPVs or hedge funds or private equity funds or venture capital funds or real estate. And also I do a lot of startup work. So that would involve representing founders in getting their company going, or in their capital raising or equity comp or tech agreements. And then from the other side, people who are investing into startups so that whether they be an angel investor or a fund. Between the two of that, that keeps me pretty busy. And I also am a sort of dabbler in programming as well. So we've done a lot in terms of just developing internal software to help continue to improve the legal profession in terms of automation.
Gotcha. Cool. So let me just start off timeline wise, right? In the beginning, we had sort of traditional venture capital funds, and they are set up in what was commonly referred to as sort of the GP-LP structure, and there's a certain amount of sort of overhead that comes with that. So Alex, if I came to you and I said, let's say 5 years ago or something like that, I want to start a VC fund, what would you counsel me in terms of just explaining the basics of how the traditional structure works, and some of the overhead involved, and whether or not you would say that, like, hey, unless you're putting X amount of dollars to work, maybe the overhead of this isn't necessarily worth it?
Yeah, that's a really good question, because a VC fund, especially, or any kind of private equity or venture capital fund, is even more rigorous than, say, setting up a hedge fund, in that you're dealing with illiquid investments, right? So you're trying to facilitate the investment of other people into illiquid assets, which means that they can't just be easily bought and sold at any time. And that creates a time horizon problem. And so the basic structure of a closed-end fund, which is what a VC or PE fund is, there's a short period of time at the beginning where you gather your assets, you find your investors, you bring them in, okay? Then you have a few years to deploy those assets, to find your portfolio companies and execute on your deals. And then there's I think some people call it informally a harvest period, or a period where those assets roll off. You have exits, you have write-downs, you have various things that happen, maybe an IPO, and you collect cash, and then you distribute it out to the investors in a pro rata way. The issue is that when you have people starting out a fund, they're often looking for investors any which way they can find, and most established VC funds are funded by institutional players who it's like, oh, you want to put my money to work for 10 years? Great. We don't have to think about it for 10 years. That's a feature, not a bug. And oh, by the way, we're committing, $10 million to your fund, and that means that at some point 2 years from now, you're going to call me and say you have 5 days to put 2 million of that into our bank account so we can close. Oh yeah, fine, we can do that. We've got $2 million. We got $50 million just sitting in the bank account waiting for us to do something with it. But in reality, for a lot of individual investors, one, they don't want to commit their money for 10 years, and two, they don't want to sign a capital commitment agreement where they literally have to provide their capital. They don't get their money invested right away, right? So they're not even earning their preferred return. They are committing to pay that money out at some point over the next few years on a very short notice, like 5-10 days maybe. So finding investors who fit that profile of being able to do those things is difficult, and so that's, I think, the hard part that a lot of people starting out have. And the other part, fund documents themselves are fairly complicated because of all the calculations that need to be done for, to calculate the different capital contribution times and things like that. So, you want to have a certain amount of capital you can raise from a group that you may not have a lot of connections in. So I think that's the fundamental difficulty.
So, and obviously there's some overhead that comes with just managing this and fund formation and getting it started. Is there a number at which you'd say, listen, like, unless you have gathered X amount of commitments, it's just from a cost of the overhead structure, it may not be worth it to have this kind of fund in terms of size? Or is it more like, unless you have these types of long-term investors, it's not worth it, or maybe both?
I'd say maybe 10 million might be the break point where you're just in the hole in terms of, like, all the money you paid out to all your advisors is going to be more than all the fees you've potentially gathered. But it varies, I think, depending on the cost of your providers, how complicated you make things, and but that's the guideline I would go. I've seen people start their first fund with a very small amount, but they have a goal to start fund 2 soon thereafter, and so they quickly scale up to 25, 40 million, and then they have a small VC.
Gotcha. So, and one thing I'll add before I hop over to Sunil is, the other gating factor for what makes it sort of quote unquote worth it is when you think about management fees, because there's a certain amount of capital formation. If you are in need of current income to fund, the roof over your head, the meals that you eat, the basics of just being a person employed by this entity, typical fees for a fund are on the order of 2, maybe 2.5% a year. So if you start doing the math and you say, okay, well, at a $10 million a year fund, at least during the investment period, the total management fees of the fund are going to be, $250,000 a year to do everything for the most part. Maybe not so much the legal cost of doing each particular deal, and there's a couple of other things that you can sort of charge to the fund, but to be able to, if you wanted to pay, if you needed or wanted to pay yourself, like that's the amount. So there's some folks for whom, doing a $5 million fund with 3 partners doesn't make sense if you're expecting the fees from this fund to sort of pay for everybody. So that's another, kind of gating factor as well. So Sunil, like, you guys have taken a couple of different shots at looking at the traditional fund structure and trying to change this around. Before we jump into like syndicates and SPVs, which is sort of a different animal, a lot of people are hearing about rolling funds. So what is sort of main difference between the way that a rolling fund works structurally and a more traditional sort of, 10-year point in time kind of entity?
Sure, I'm happy to get into that, but maybe it might even be worthwhile to kind of back up and set the stage on what we're trying to do at AngelList, because I think it's very, very relevant to the last question. So if someone wants to start a venture fund, there's 7 or 8 different component parts of what is a venture fund. Legal is one component. So you need the structuring, you need the LPA, the PPM, subscription docs. You also need a bank to hold the money. You need a fund administrator to execute on the back office work. someone to do valuation work, someone to do the tax work for you and your LPs, someone to manage distributions, portfolio management software. And for any venture fund, regardless of size, you need those subcomponents in order to like run smoothly. What we're trying to do at AngelList is basically bring all of those things together. So whether you're running a special purpose vehicle, whether you're trying to do a traditional venture fund or a rolling fund, we've essentially productized these offerings. So instead of going to 8 different people for these services, you go to AngelList, it's almost like a fund or an SPV as a service. And so that's kind of what we're doing at AngelList. And we found that when you bring these things together, when you vertically integrate and you use technology to make them a little bit more efficient, you can bring down the costs. So for example, some funds on AngelList can be as small as $500,000. As opposed to like that $10 million marker, you can reduce the barrier to get started because you're using technology, you're not using a bunch of bespoke custom services. It becomes easier to get an off-the-shelf fund up and then you're into business. So that's just kind of setting the stage. To answer your question specifically around rolling funds, as Alex mentioned, there's a specific known process for raising a traditional fund. You say you want to do a fund, you get the fund structure set up, then you have 18 months to raise. You're traditionally flying around the country, meeting LPs, you've got those 18 months. At the end of 18 months, it's pencils down. Maybe you wanted to raise a $10 million fund, but we're in a pandemic and you end up at 6, your fund size is 6 million. And because you have that, that known timeline, it creates a little bit of a pressure situation where you're out raising your fund, you might miss out on deals because you're talking to fewer founders. Or, what happens if you meet an interested LP in month 19? You've already had your final close. There's no real way to work together. So the concept behind a rolling fund is if you were to rethink how venture operates today as a model, how would you do it differently? We said it would probably look more like a subscription business, closer to like almost a Netflix subscription, where essentially what you're trying to do is collect capital from some people and invest it. And so the clean way to think about essentially what is a rolling fund is it's an open-ended venture fund that LPs subscribe to quarterly. So now you don't have that 18-month time pressure. You can invest in deals as you see them. You can stack these subscriptions and grow your fund size over time.
So one of the things that Alex said, which I thought was interesting, is the whole like feature, not a bug thing. Mm-hmm. For institutional investors, many of them want to put the money back, want to put the money to work over a long period of time. Mm-hmm. When you talk about an open-ended fund, that door swings both ways, right? In terms of, let's say I'm an investor and it turns out that the first 19 deals I do are just a mess, just total, god awful kind of thing. And the 20th is the real winner. One of the things that I think of in a traditional fund perspective as a feature, not a bug, is the lockup in the commitment. The fact that you have agreed to be with me over the long term. When you're doing a quarterly subscription, you can get people on at any time, but they can also back out, right?
Yeah, so this is an important point to note. Subscriptions are legally binding, so there is consistent capital coming in, and subscriptions don't just happen one quarter by one quarter. So I totally agree with you. So what we see people structure their rolling fund as is, if I'm an LP and I want to subscribe to Charlie's fund, he could say, I have a 4-quarter minimum or an 8-quarter minimum. Now, me as an LP, I can't say after 2 quarters, this isn't fun anymore. I don't like your deals. I'm in for 4 quarters or 8 quarters, depending on what I've signed for. So I would say the door does swing both ways. We allow you to set minimums. If maybe there's an LP who wants to, get their feet wet and say, let me try this out for 3 quarters. I know the risk I'm getting into. Maybe none of the deals will hit, but I want to know what it's like to work with Charlie. Can I sign up for 3 quarters? If you're okay with that, you can say that's fine and you can let them into your fund, but you can have your default as 8 quarters, 12 quarters, or 16 quarters. It's entirely up to you.
What are you seeing as market? What are people setting as their minimums? And then how many, in practicality, what are people, like there's the headline minimum, and then there's the side deal for friends and family. Like what are sort of typical?
Yeah, typical, I would say, is about 4 quarters. You want people in for a year, so you as the GP have predictability of capital. You know, you don't want, if the market tanks, you don't want a lot of people pulling out the money. So 4 quarters is probably pretty common. When you are talking to the larger folks, like family offices or maybe even institutions, they want, you know, I agree with Alex, they want a longer lockup period. They want to put their money to work and not necessarily think about it. So one way that if I'm talking to a GP and they're like, how do I pitch this rolling fund idea to this family office? I say, okay, well, the family office typically wanted to invest $5 million in a traditional fund. That would get them, let's say, 2 years of exposure to deals. That fund would be invested in 2 years. So you take 5 million, you divide it by 8. Now they have 2 years of exposure to your rolling fund.
Gotcha. And what is the actual entity and mechanism like? Like, who is the fund? What is my relationship to the fund? Like, how does that structure actually work out? And is it one fund in perpetuity, or does it look like some other different kind of structure?
Yeah, it's a good question. So the funds are U.S. Delaware LP entities, so pretty standard. And the magic trick that allows rolling funds to work, and why it's only really possible to manage through software and technology, is we're essentially spinning up a new fund every quarter. And that's what allows LPs to come in and out at different times. So it becomes incredibly complex to see which LP came in when, how many quarters they were subscribed to, who gets carry for what. And we're taking all that responsibility on in terms of structuring and managing those relationships.
Am I the GP of each of these underlying funds?
So technically, AngelList is the GP for all of the SPVs and traditional funds that we manage. We do that for 2 reasons. One is operational efficiency. We can sign and execute docs on behalf of the fund. It's super simple. We don't need to get held up waiting for anybody. And then second is actually liability shielding. So as the GP, worst case scenario, let's say you have an LP, you didn't do enough diligence on them. They signed up for the fund. And then 2 years later, they're like, where's my 100X? I didn't know I would be locked up for 10 years. Where's my money? And they're kicking and screaming and threatening to sue. AngelList has to deal with that. That's why we build in a lot of kind of the protections within our disclosures before they sign. Everything is, startup investing is very risky. You're likely to lose your money. We kind of protect investors on both sides because we take on some of that responsibility. You are termed as in the docs as what's called the fund lead or fund manager, and you get paid in fees and carry for sourcing and negotiating investment opportunities.
Gotcha. And how does the carry structure work when not every, so typical fund, right? 3 or 4 year investment period until all of the deals from that period return capital, I don't get paid. In a rolling fund, you know, I have all these little quarterly funds. Like, can I start getting carry from a quarterly fund, or is there a minimum threshold for the whole thing?
The threshold is on what you set. So again, if you're the, you know, if you're running a rolling fund on AngelList, I'm an LP. Let's say we come to an agreement. I say, Charlie, this looks great. Sign me up for $250K every quarter for 4 quarters. Mm-hmm. And then in Q2, you invest in a fantastic company. It goes on to IPO for $1 billion. As an LP, I need to get paid back $1 million, $250K for 4 quarters. So my subscription term was $1 million. That's my principal capital. Once I get paid that back, then you start to see carried interest. If there was
so every LP's carry deal is individual.
Exactly. So if there was another LP who signed up for 2 quarters, Q1 and Q2 at $100K each quarter, you know, Q2 you invest in a great company, that LP gets paid back $200K, then you see carry. So it's all individualized.
Gotcha. So what is the #1 pushback that you guys get? And I don't know how far up the chain you are offering this, but you know, Excel comes along and like, why would $1 billion fund who has all of the infrastructure and traditional investors not go for that structure? What, as you know, with larger, more institutional funds, why would you say maybe this isn't appropriate for what you're doing?
Yeah, I would say there are two parts to this. One is why they wouldn't today, and maybe why they should. So why they probably wouldn't today. This product is new to the market. So it's about, we launched it 1 year and 1 week ago. So very new to the world of venture capital. Traditional fund structures have existed for 50 years. So there is some education that needs to happen on the LP side. If you're an endowment, a university pension plan, this is new to you. And so you have a diligence checklist. You've invested in these funds this way for the past X number of years. So this is introducing some change, and it's new, it's innovation. So slower to adopt on the institutional side. That's probably why it's not happening today. We are getting interest from a lot of folks who want to take advantage of this model, who want to basically include more folks. If you are Excel, you probably have a couple handfuls of institutional LPs in your fund that have been investing with you. But what if you want to bring in smaller operators or family offices? And you want a different type of relationship with them. So we're getting interest from some funds to set up a parallel rolling fund that will invest side by side to their core fund and include a different type of community, a more flexible structure, lightweight, and then that fund would, when they're doing a deal, invest from their core fund and their rolling fund. So we're already we're setting that up today.
So that's a great. So now I'm going to flip back to the lawyer on this kind of question, because there are some issues with parallel funds and front running deals or at least allocation of deals. So if Alex, if you were advising me and I said, hey, Brooklyn Bridge Ventures, like I like our shtick and I'm sort of a traditionalist, but I have a bunch of people on the side here who might want to invest side by side. Maybe they're smaller, maybe they can't commit to the same, kind of deals. Are there any issues or things that I should think about if I'm running more than one type of fund at the same time in terms of how much I allocate to one fund and how much I allocate to another?
Yeah, sure. So allocation of investment opportunities is an issue that fund managers face. It's a more general issue of conflicts of interest that an investment advisor faces. Fund managers are considered investment advisors under the law, which is a type of regulated entity. Now, often venture capital fund advisors are not required to register with the SEC as an investment advisor, but they are still investment advisors. They're required to act in the best interest of the funds they manage. That becomes a problem if you, say, have two funds that have the same strategy and you don't have procedures in place to determine how the investment opportunities get allocated between those two funds. Often, a fund manager, if it has one main fund, will only have one of those main funds going at the same time. Now, that doesn't mean they can't overlap over the entire period, but while they're deploying capital, the easiest way to deal with that is to have one fund that you send your investments into, and then when you've used up all your capital, then you can start fund number 2, 3, 4. Now, the issue, Charlie, that you brought up about other investors with other sort of investment needs, there's a variety of ways that could come into play. There could be different strategies, in which case you might have two funds operating side by side that have just a different outlook on who or who they're going to be investing into. So one might be a fintech fund, one might be a more traditional diversified VC fund.
Somebody wants to cherry pick only the Brooklyn deals out of Brooklyn Bridge Ventures Fund.
Yeah,
instead of all of the New York City deals.
That's right. There's a lot of permutations there. There's also the concept of co-investments where let's say you might have the ability to bring in a large allocation from an investment offering that you have investors for, but you don't want to have, let's say it's the Uber of funeral directors, right? Like, really weird niche thing. You think it's going to be big, but it's not going to, but you don't want to stake 60% of the fund on. And in fact, your documents would prevent you from doing it. Well, you can invest the amount you think is appropriate in the fund and then create a SPV or side vehicle that also invests in it, that just invests in that individual offering. And so the other investors who do want to invest in this next big thing of the Uber for funeral directors can invest into that side vehicle to get that increased exposure, whereas the rest of the investors don't get that exposure.
So I'm glad you mentioned sort of the SPV and the individual deal stuff, because there are instances where, you may have more of a certain deal or even in follow-ons. And I'd also like to find out from Sunil how follow-ons might work in a rolling fund structure too. But, in terms of these one-off opportunities, Alex, you've been putting together SPVs and sometimes it's, some of the folks in the audience might be thinking of rolling funds as an interesting structure, but they may not necessarily have the track record or the ability to get even a multi-quarter commitment. I know when I first pitched my first fund, there were a couple of LPs that were like, well, show me a deal first. Show me, let's talk about each individual deal. Let's do a few deals together, and then maybe I'd be interested in this. And I know a bunch of folks who have gotten started by doing individual sort of SPVs. What's a sort of typical structure for an SPV, and in what way is it lighter or easier to spin up than a traditional fund? If you're just saying like, hey, I got this one deal, it's a unique opportunity. I don't know if I'm really in this to be a fund manager, but I just want to put money into this one thing. Like, what's that structure look like?
Yeah, it basically looks like the VC fund, but simpler. Instead of having to track multiple investments and have lots of different closings where you have different cross allocations and things like that, you usually have one closing, or maybe you have a few like right within a short period of time that invest together in a single investment. It's very straightforward. When the exit is. It's not, you don't have different investments exiting at different times. And so it's just a much smaller scale version of the same thing. So the documents are simpler, so that's good. The fundraising is usually simpler. And there's the added benefit that it's a good first step for people getting into this, because they don't need to have that trust with the investors need to trust them somewhat, but like if you're a VC fund manager, your investors are, one, trusting that you're not a crook, two, that you have an ability to pick good investments, and they don't know what your investments are. So
it's a blind pool.
Yeah, it's called a blind pool, right? Is the term. So you can't, you as an investor have to know that they're just going to, that they're going to trust you to pick these things. An SPV, they get to see it and say yes or no on the particular investment. And there are lots of fund managers that start out initially just doing SPVs, and that way their investors don't even have to establish that level of trust that you're a good picker of things, because they can do for some secondary vetting on the investment choices.
What kind of administrative overhead and fees associated with that should I be setting myself up for? Like, I'm creating a legal entity. it's got to file some taxes, I imagine. I should be leaving some money here to manage this thing, and then we'll jump over to what the AngelList version of this might look like.
Yeah, that can vary a lot. So if you're in a state that has an investment advisor exemption that doesn't require audited financials, for instance, that's going to make a pretty big difference. So some fund managers, depending on where they are and how much money they have and how many funds they have, may have to get each one of their entities audited, right? And if that's the case, then that can get very expensive as you scale up. But if you don't have to do that and you're able to structure these in a way that you don't have to do that, you just have to pay for tax return every year, maybe a few $1,000s. You may or may not need admin services on a single asset SPV with very little liquidity. I mean, that may be an area where you don't need to spring for the admin services if it's a truly simple and straightforward fund. So it's not huge, but it is there, and it's something you have to plan for.
Gotcha. So Sunil, when I think of one-off deals, I think of syndicates, but I don't like the implementation of a syndicate, at least the way I've seen them used, is that they spin up for multiple deals. But I guess I could theoretically come to AngelList if I just wanted to do one deal and just make it a syndicate for like one deal. I don't know how many people do that, but is that a thing that people do?
Yeah, one way just to be clear is like your syndicate is basically an organizing function. There's not an entity behind a syndicate. It's just kind of your home base on AngelList. So if you wanted to do a single deal and it's your deal, you could create Charlie's syndicate, and then you go through the flow and you submit a deal. When you send it to LPs, they're going to see Charlie's syndicate is investing in company X. And then let's say a couple of years later, you decide to partner with Alex and you guys want to run a syndicate together because you think you'll do multiple deals together. You could form Charlie and Alex's syndicate, and then you do multiple deals under that housing. So it's all just kind of a naming convention. So you can have multiple syndicates, but every SPV, every individual deal, that's a real entity and it falls under that syndicate naming.
Gotcha. And is it similar to a rolling fund when I do a syndicate is for liability purposes and simplicity purposes? Is AngelList the GP there, or am I the GP?
Yeah, across all SPVs, traditional funds, and rolling funds, AngelList serves as the GP.
Gotcha. Why would I think about a syndicate versus a rolling fund? Because I still, I'm still on the, every other day, Jason Calcanis in a syndicate have another deal to send me, and so there's no rolling fund. And I'm just sort of curious, and maybe as to why someone would choose a syndicate versus a rolling fund.
Sure. I think there's a couple of reasons, but I largely agree with what you both were saying earlier. I generally, there's always exceptions to this, but generally I think the trajectory for someone that is an investor, they'll typically start writing angel checks. They've got their network, maybe they've worked with people that are starting companies, and then they get on the cap table with a 10K, 20K check. They do some angel deals, and now they want more leverage. So then they move on to SPVs. I can get into these deals, but instead of 10 or 20K, maybe I should invest 100K or 200K. And I have other people that want to go alongside of me. So that's when really I think people start with SPVs. And for the reason you all mentioned, it requires less trust because I can show you the deal. It's not, do you trust my blind judgment? It's, are you interested in this specific opportunity? So that allows you to steward outside capital. Now you have a little bit of a track record. You've shown you can do angel deals. You've shown you can use other people's money. Now it might be time to run a fund. And I would say you should be a candidate for a fund if you know the cadence on how often you're seeing great deals and you have the trust of LPs. If you're only going to do 1 or 2 deals a year, that's completely fine. You should feel no pressure to do a fund. An SPV makes sense for you. But if you're like, I really like investing, I'm seeing a couple of high quality deals every year. Maybe I'm seeing 5 or 10 deals every year. I want to do a fund. That's when it makes more sense. But there's not a right way of doing it. It's really based on how often you're investing and your LP network, and how professional you want to make it.
Gotcha. So the questions have started piling up, and so I want to get to them before we wind up letting you guys go. So how do fees work on the rolling fund? Is it just the prorated 2% on whatever commitment people have signed up for, or is it anything?
So essentially, AngelList charges a fee to run these funds, because what we're doing is we're setting them up, we're managing, doing all of the infrastructure for it. And any management fee you charge goes to you entirely. The AngelList fee is an administrative fee, so it's separate from that. It doesn't come out of your pocket, it comes from LPs. And so going back to that concept that I mentioned earlier, we're essentially spinning up a new fund every quarter. So we charge per quarterly fund, and we charge 1.5% one time of the capital you have in that quarter, with a minimum of 20K to AngelList per quarter.
Now I got to do some math and sort of think about, is there a break-even point on size at which it's essentially similar to what it would be? Because at some small size, you're way eating into.
Yeah, it doesn't. I would say a rolling fund doesn't make sense if you're investing less than 250K of capital per quarter. That's kind of the mile marker. Like, it's rough. Like, people can do it if they want to, but it's not a great experience for you or your LPs because the fee load is too high. But if you have 250K of capital coming in every quarter, then that 20K minimum means about 8% in fees. So 92%, if you're not charging any management fee, 92% of capital is going straight into companies. If you're doing 100K, that's SPVs probably are a better deal, or even a traditional fund might make sense for you.
Gotcha. That's an interesting way to sort of think about it, as you think about the 3 to 4 year sort of investment period of traditional funds. If you're talking about 250 grand a quarter or $1 million a year, what you're essentially saying is, like, you can do a rolling fund if you would have otherwise had a $3 or $4 million fund. Whereas in a traditional fund structure, maybe it doesn't make sense until you get to the kind of 8 to 10 range. So you sort of brought that down. But there's still, like, unless you can gather the functional equivalent of a $3 or $4 million fund, it may make sense to just stick to the one-off deals.
It's up to different.
You just don't have to get it all at once as part of it.
You don't have to get it all at once. We also have like a traditional fund structure with a different pricing model. So it's up to people on what they would like to do. But the component of I guess one of the features that we really tout on the rolling funds is you don't have to have it all up front. You can get into business small, and we've seen this across all of our funds. You can start with 200K, 250K per quarter. And rolling funds allow you to generally solicit. So you can go on Twitter, you can go on a podcast, you can write a blog post about your fund. And one of the big constraints of why fundraising traditionally has been so hard is you can't talk about it. So it all has to be backroom conversations privately. But if you can think out loud, if you can tell people, hey, I'm raising a fund, this is what I invest in, are you interested? That increases the surface area. And we've seen people go from 250K per quarter to 3 million per quarter very, very quickly. And so the idea is rolling funds allow you to get your start, and you can start small, and then these subscriptions stack and you can grow over time.
Gotcha. So Alex, there's a really big disincentive for people to fall through on their commitments in a traditional fund. What happens if I get, a $500,000 commitment and midway through the guy ghosts on me and doesn't put in? What's the mechanism usually?
Well, yeah, I mean, it's a default under the agreement, and it allows the general partner to do a whole bunch of potentially nasty things to the LP to incentivize them to do it. There's obviously it varies a lot from agreement to agreement, but list of things are: you can be sued in court, you can charged interest. You could potentially have your interest devalued. It could be sold at a sort of fire sale price. Yeah. You often lose voting rights. There's just those default sections are drafted to be so onerous that no one would even want to think about defaulting.
Right. They'd sooner sell their piece than like lose what they put in, essentially.
Yeah. I mean, it's pretty close to losing, you know, often a majority of your money that you put in.
So, Sunil, obviously some of the commitments are have a shorter duration, so hopefully you have less people defaulting. But if you had a person default, what is the mechanism?
Say exactly what Alex said. So, you know, at the most extreme, you sue your LP. More commonly, they, you know, decrease their ownership in the fund, or like, you know, if they're just late, you can charge an interest, but it's up to you as the fund manager on what you decide to do. We don't see it very commonly. You know, it's the same as a traditional fund in that sense.
Gotcha. Have you seen in the rolling funds, given that some of the people who are doing this are getting started might be, you know, traveling in circles of folks with less capital and therefore maybe in the same position themselves? So talk about the GP commitment and you know, how that is the same or different than in a traditional fund.
Yeah, so the GP commitment is basically showing incentive alignment with your LPs. You're saying, I'm putting in money into the fund because I believe in myself too. If I don't do a good job, I'm going to lose my own money. It's great to share that, to have skin in the game with LPs, to prove that you're going to take this job seriously and try to, you know, create a great multiple on your own money. Industry standard is for the GPs to put in, let's say, like 1 to 3% of the size of the fund that they're raising. The problem is that not everyone has the same amount of liquidity. If you're earlier in your career or for whatever reason you have less cash, then it's really hard to meet that GP commitment. And you still might very well be interested in creating a great fund, but you just don't have the cash. So AngelList isn't trying to play gatekeeper on any of this. If you, you know, we will disclose it to the LPs just so everyone is, you know, aware of what's happening. But if you have, you know, only the ability to put in $5,000, $10,000, but you're able to raise a $10 million fund, that's fine as long as you and your LPs are aware of it. It's disclosed. So there's no hard minimum requirements on AngelList. One feature that we do have is that you can make what's called a cashless contribution. And what that means is, like, let's say I'm the GP, I'm charging management fees. Instead of those management fees leaving the fund and getting paid out to me, I'm going to reinvest that back into my fund. And a portion of that or all of that will be my GP commitment. So I'm going to basically not take management fees, but that's going to be my GP commit. That's one option. And a third option is you could contribute some of your angel investments into the fund. So essentially the fund will purchase those investments or you contribute them into the fund, and that's your GP commitment. So instead of putting in cash, if you've been investing in companies for the past 5 years, you could put those into the fund.
So next question that have come in, there are a couple of, you know, over the course of sort of 30 deals, in a sort of traditionally diversified fund, you know, you might get 1, 2, maybe 3, you know, home runs. Is there a chance that, you know, knowing this sort of long tail of results, that that you're going to have a lot of people missing out if they're sort of pulling in and out, and you know, that a 2-quarter commitment or a 3-quarter commitment, that the likelihood that you hit the right one is it's going to be tough?
Yeah, it goes back to the standards that you set. So in a traditional fund, there's one way of doing it. I sign up for your fund, you invest that capital over 3 years, we wake up in 10 years and see if you made a multiple on that investment. That's fine, but that's only one way of doing it. You can still do that with a rolling fund. You can still say I'm making a 3-year commitment, so that's 12 quarters, same exact thing. But it does allow for something more than that, which is there are many cases in which I'm an LP, I just want to get to know you first. I'm new to this venture capital thing, or we haven't worked together. I want to try this out for 1 year. I want to check out your LP updates. I want to see how you think about companies. I want to see how you are as a fund manager. And after that 1 year, I might choose to double down for another 2. I might increase my subscription amount, or I might drop out. It gives me the flexibility to do that. And it's not dissimilar from a traditional fund in terms of risk. Let's say I invested in your traditional fund 1, you didn't have any winners, so I missed out on I didn't invest in fund 2. Fund 2 is when you hit the Uber. People miss out on deals all the time. So it's really how you structure it and what you're trying to accomplish as a GP and as an LP. I think that this offers everything a traditional fund does, plus additional flexibility to incorporate a different type of LP.
Gotcha. Alex, just one of the points that Sunil made is about general solicitation. What are the sort of requirements and limitations if I am going out and sort of raising a fund, both in terms of like the letter of the law and also, how people sort of typically treat it in terms of raising a traditional fund?
Yeah. So the whenever you raise a fund, there's 2 commonly used versions of essentially the same private offering exemption. So the original version of the offering exemption was called Rule 506B, or it was called Rule 506 because there wasn't a separation of different types. And it allowed people to raise money from accredited investors, but they had to be, or they had to not use general solicitation, which has meant a lot of different things to different people. If you asked most people how they were treating that, they were saying they couldn't advertise it. So don't post it online. Don't, send out a big mass mailing. Don't do cold calls. Don't put an ad in the paper. If you ask the SEC, they took a very strict rule of it had to be your pre-existing contacts before you started the offering. I guess I would say they didn't say it had to be, but they said, we're willing to bless if you only sell to your pre-existing contacts. And if they're not, well, who knows? We'll just have to see. And so that's sort of the basis by which people would maybe expand that circle a little bit. Then back in 2010, 11, 12, there started to be this movement towards allowing general solicitation, but what ended up happening was they added all these verification requirements to that. So there's a real balancing that you have to take there. You don't have to worry about whether you knew them or whether you found them on the internet or whatever, but for every investor you have to actually look at their income or their net worth to determine whether they actually fit the qualifications. Now there are third-party services that will do that for you. Maybe even AngelList offers that as its own product. I'm sure it's part of their overall offering. So there may be ways of getting out having to do that yourself, but no matter how you cut it, you're going to be excluding some investors because there are some people whose wealth comes from private holdings, like maybe their own company, that they are willing to say they're a credit investor in regards to, but they can't prove it because they don't have valuation or something like that. There are also people who find it offensive or don't want to do it. There's just a lot of logistical hassles that come with getting the verification done that do make it, that do add some significant downside. So it is not a no-brainer as to which one you use.
Gotcha. Sunil, one of the couple of the questions have to do with some of the dealing with follow-ons, but also dry powder is the term for when you have commitments but you haven't necessarily put the money to work. So let's take follow-ons for a moment. If I have the ability to do the next round of a deal, let's say like I've got my Q1 2021 fund, and come September, one of the deals that I did then is doing their Series A, and I got pro rata rights and I have the ability to put in more. Which fund does that investment?
Yeah, we leave it up to the GP and to set that very clearly up front with their LPs. So there's kind of two ways you can do it. One is to say, okay, whenever I get a pro rata opportunity, I'm going to do it out of the fund that I currently have. So if you seed invest in a company today, Q1, and then in Q3, it raises a Series A from a great venture firm, whoever is in Q3 gets exposure to that deal because that's when the pro rata happened. And so it incentivizes LPs to stay with you to kind of take on the follow-on opportunities. So maybe they want to extend their subscription if they're excited about the companies that you're invested in. The other path, which is an interesting hybrid, is to, and Alex mentioned this earlier about, allocation policy and being upfront about your thesis of what's happening from the fund. Some fund managers have chosen to say, my rolling fund is just going to do first check investments into companies. Anything that's a follow-on or pro rata, I'll spin up an SPV, and then I'll invite the investors who are in my quarterly fund at that time. So they can double down in an SPV. And if it doesn't fill, then I can invite new investors. So it's up to you as long as it's clearly disclosed and your LPs are aware of it.
Gotcha. And so what happens if I just don't fund any deals this quarter? And, the market was tough. I don't want to just put my LPs into, garbage stuff if I just had a tough quarter in terms of deal sourcing.
Yeah, that happens. Basically, the idea of the rolling fund is that the capital rolls over. So if you had $1 million in Q1, but you invested $700K, at the end of the quarter, you can elect to return the $300K back to LPs if you want, but more commonly, it simply just rolls over into the next quarter. So now you have that $300K plus whatever you raise in Q2.
Gotcha. Last two questions. What have you seen any institutional commitments yet into a rolling fund? And by institution, I like family office could mean a lot of things, but I mean more like traditional institutions, either like fund of funds or pension endowment, like those kinds of guys.
Going back to what I said earlier, product has been in market for a year, so it's going to take a long time for that world of large institutions to get comfortable with this structure and how it works. So we have had very large family offices. We've had private wealth groups. We've had venture funds invest on the order of very large institutions, not yet. But I see that coming, very, very near into the future.
Gotcha. And there was just a GP, I think it was Arlen, who raised her fund off of Republic. And they did some capital introduction type stuff. Is that a feature that you guys are thinking about doing, or is it basically like up to me to sort of find everybody who goes into the fund?
So everybody that invests into these rolling funds or traditional funds or SPVs needs to be an accredited investor. So based on what Alex was saying, there are certain criteria based on net worth, salary or assets other than your primary residence that the SEC defines as you are an accredited investor. So everybody must be at least an accredited investor. A lot of our GPs are bringing in folks from their network, but we also do have a directory. So we have AngelList.com/rolling, where you can go right now. And because these funds are able to generally solicit, they're structured as 506C, you can see funds that are live right now. And we direct our LP base. We've transacted over $2.5 billion through the platform. There's a bunch of LPs that are sitting on AngelList that are looking for high quality emerging managers to invest behind. And so we feature some of these funds that they can take a look at. And if they're interested, they can invest behind them. So the answer is yes. Primarily the GP is bringing their own LP relationships, but there is a very popular mechanism of AngelList helping drive capital from the platform LPs as well.
Gotcha. Awesome. Well, listen, thanks everybody so much for this has been like super informative. And how can folks get in touch with you if they have more questions?
Yeah, anyone can just email me. So I'm just Sunil, my first name, SUNIL @angel.co. If you have any questions about any of this stuff or just interested in learning more, happy to chat.
Yeah.
And Alex?
Davey @riggsdavey.com, or you can just go on to riggsdavey.com and click the contact us button. That's RIGGSDAVIE.
Cool. Thanks so much, guys. Really, really great stuff. I
All
appreciate it.
Thank you.
Take care.
Bye-bye.